Welcome back everybody to another episode. This time we're going to be talking all about psychology, okay, and the different kind of elements of psychology that you need to be aware of to be successful as a trader. So what actually is psychology in relation to trading? Well, I would say when learning how to trade, your trading journey should be made up of about 85% psychology, okay? And then I would say the other 15% is actually technical ability and being able to formulate some kind of trade idea in the markets. So when you take those numbers and you think about it, most of what you need to know is psychology based. Everything in the markets relates to psychology, how you're feeling during certain positions, okay? How you're feeling on a day-to-day basis, and everything, okay, ties back in to psychology. When you have a win, when you have a loss, when you're managing a position, when you're analyzing the chart, there's always going to be some kind of psychological element at play, okay, that you need to be aware of and be able to manage and have it under control to make sure that you have your psychology completely in check and that it doesn't interfere with your decision making when trying to trade. Now, there's a number of different psychological issues, okay, that people face when trading. These are things such as FOMO, which is the fear of missing out, things such as the fear of losing. You have things like overtrading, and of course, revenge trading, where you're constantly trying to make back the profits, and as a consequence, you end up risking too much on your account, and then you'll end up blowing your whole account. So what can we actually do to combat these different psychological problems that people face? And the main thing you can do is have a solid understanding of what's actually happening, okay, and being aware of these different psychological problems that can actually occur is the best way to be able to manage it when you notice that it's actually happening to you in real time. So the first thing I want to talk about, okay, is the fear of missing out. So FOMO, or the fear of missing out, refers to when your fear will overcome your ability to place correct positions in the market. Now, anyone can have a fear of missing out, okay, when trading, because no one knows when the market's going up or when the market's going down, and at any moment, an idea that you may have predicted could play out with or without you, whether you're involved in the market. But of course, as traders, it's up to us to make sure that we're in at the correct position to ensure that we capitalize on that trade without getting stopped out beforehand. And this is, of course, where FOMO comes in. Now, when we talk about FOMO, okay, it's best to look at it in this kind of way. Now, there's going to be a number of different steps that happens, okay, in order for you to get a fear of missing out, okay, and it's going to be related to how underprepared you are. So here you can see we have failure to prepare equals emotionally reading the market, which then leads to a fear of missing out, which will then lead to an early entry and a loss. So let's just think about, okay, each of these phases and the ways in which this could occur to you and how we're going to avoid it. So of course, the first part of having a fear of missing out will be from a failure to prepare. Now, what do I mean by this, okay? Well, failing to prepare because you don't have a plan, and therefore you may be worried that the trade idea may go without you. So of course, okay, let's say in an example situation, you're predicting that the market's going to be going to the upside. You have all your analysis on the chart. Say you have an area of interest, okay, so say an area of support, and let's say you've got some kind of descending channel approaching this area. Now, let's say, for example, you don't have a trade plan. So you don't really know exactly what you're looking for to get involved in this market. However, you just feel as though the market's going to be going to the upside because that's what it looks like. You're seeing some kind of early indications of bullish intent. So you feel like the market's going to go to the upside, but you aren't fully prepared for that position. Okay, now this is going to cause you to become very emotional, okay, and this fear and this worry will lead to you reading the market in an emotional way. So instead of being very robotic about the situation and waiting for certain things, okay, based on your checklist and just only get involved if these certain criteria are met, what you're going to be doing is starting to emotionally read the market. You're going to be thinking, oh, it's looking like it's going to go up here. And then out of emotion, what you're going to end up doing, okay, is just rushing into that trade. So as we see, okay, a failure to prepare equals emotionally reading the market. So now you feel as though the market's going to go up, but you don't really know how you're going to get involved, okay? So you may just click the buy button, or you may be very, very quick to react to, say, one little low test candle, or you get one bullish engulfing candle, and now suddenly you're clicking in, okay, and you're trying to trade this to the upside because all you're doing is emotionally reading the market. So this will then lead to you feeling, okay, as though you're going to be having a fear of missing the position, and then this lack of plan and the fear that comes with it overcomes you, and you get the fear of missing out, and consequently leads to you rushing into a trade that you haven't even really thought about and goes against your plan, which then leads to you taking a loss and the market moving in your predicted direction without you. So this is the clear cycle, okay, from a failure to prepare to an early entry and a loss, because what you're likely to do is jump in the market very, very early, not have your stop in the best position, get taken out of the trade for a loss, and then it's going to move in the direction that you predicted, because the likelihood is that you were actually in the right area, but because you weren't psychologically sound and you were very, very emotional and you were trading from a fear-based mindset, it caused you to make a mistake, okay, and then you got punished for it. So FOMO is a very, very common thing that happens to traders all the time, and a lot of the time, okay, it comes from this ability to fail to actually prepare properly for trades, and again, this cycles back round to not having a trade plan. So trade plans are very, very important, guys, okay? If you want to avoid FOMO at all costs, try and remain, okay, as neutral as possible, and just remember, okay, it's a game of probabilities. Okay, everything's based on probabilities, and if you've got your edge, you just need to follow that. Don't be worried if price doesn't tag you in, okay, or price doesn't set up in a certain way. Don't worry about it, because after a certain amount of time, you're going to get an entry that fits your plan because you know it's going to happen, and then you can capitalize on the market, okay, not before then.
The best time to take action is now. What are you waiting for? Tired of struggling with market direction? Want buy and sell indications at a click of a button? Who wouldn't? Check out TradeDork's buy and sell indicator today at TradeDork.com.
Now, another very common psychological issue, okay, is the fear of losing. Now, what do I actually mean by the fear of losing? Well, if we have a little look on the diagram here, what have I put? You can see, first of all, get rich quick leads to over-risking on your account, which leads to a fear of losing, which then leads to missing winning trades. Okay, so here you can see that each step of this diagram, okay, they all tie in with each other, and it's all related to that feeling of wanting to get rich quick. So what do I mean by this? So let's say, for example, okay, you come into trading with that get rich quick mindset. You feel like you're going to flip your account overnight. Okay, you may not have that much money to trade with. Okay, and you may be quite an impatient person. Okay, you might want things to happen very fast for you. Okay, so what will happen with that is it will cause you to not want to stick to strict risk management, okay, and capital preservation. Instead, what you're going to want to do is trade, say, 5% of your account per trade or 10% of your account per trade, because the money isn't quite enough for you. And what you want to do, okay, is try and flip your account as quickly as possible. Now, the problem with doing this is that it really messes with your mind when you start to take losses. So let's say, for example, okay, you risk 10% of your account per position, and now you go into a losing streak, and now you've had, say, 3 losses in a row. So now what you're doing, okay, is you're having a get-rich-quick mindset, and now you're over-risking on your account because you're risking 10% per trade. So now you're down 30% on your account. So now all sorts of things are going to be crossing your mind, okay? And the problem is, what you're going to develop is a fear of losing. And by having a fear of losing, what you're going to do is you're going to hesitate to click the button and enter the position. And it all relates back to the fact that you're risking too much. Because once you have a fear of losing, and the cost of losing becomes too great for you, you're going to stop trading your plan, okay, robotically, and instead what you're going to do is again start trading on emotion. And by trading on emotion, you're going to miss winning positions because you're going to see a setup, okay, and then you're not going to trust that position. You're going to feel as though, oh no, well, I've just had 3 losses and I've lost 10% every single time. If I lose another trade, I'm now going to be down 40% and then 50% and then half my account's gone. So then what you're going to end up doing is looking for very, very, very strict trades, okay? You're going to be looking for way too many confluences. You're going to be looking for that golden trade because you could not afford to lose at all. And the problem with doing that is that it goes against your plan. It goes against everything that you've back tested, okay? And the problem with doing that is you're going to miss winning trades. And if you then miss those winning trades because you've hesitated, because you're too scared to enter the trade, what's going to happen next? you're going to miss the wins, and then you're going to go straight back into the losses. So then in a sequence of 10 trades, let's say, for example, you're supposed to win, say, 5 of those trades and lose 5 of those trades, okay? What's going to happen if you start missing out on your winning positions? Well, then say, for example, you might still lose all 5 of those trades, but then you might only take 2 of the winning trades. So now suddenly you're actually down even more on your account because you failed to execute the plan and follow it properly. And again, it was all psychological based because you didn't have to risk 10%, but it was coming from an area of greed, okay, which was related to getting rich quick. Okay, you lacked patience and you were greedy. So you over-risked on your account, and the problem with doing that is it then led to more fear, the fear of losing, okay, the fear of losing your account. It prevents you from trading clearly, and it prevents you from being very systematic with your whole method and approach, okay? So it's very, very important to be aware of this. This is why I say risk no more than 1%, okay? Maybe 2%, okay, if you really knew what you were doing, but I would not risk any more than 1% or any more than 0.5%. And why do I say this? It's not only about capital preservation and the fact that it will allow you to trade for a long period of time, it's also mental, because if you know you're entering a trade and you're only going to be losing 0.5%, you're very likely to still click that button. And the main thing we need people to be doing to be successful traders is clicking the button. Okay, you have to be entering the trade when the plan tells you to. If you don't do this, then you're not following your plan. And if you don't follow your plan, then you don't have an edge. And if you don't have an edge, you're not going to be profitable. So everything always links together, okay? And you have to really pay attention to these psychological issues because everything's emotional based, okay? Trading, like I said, 85% I would say is psychological. And why is that? Trading's very, very emotional, okay? It's all the emotions heightened. And you have to try and overcome that and trade and be your best self during these situations. The last thing you want to do is be someone who's very, very emotional while you're trading, okay? You almost have to have no emotions. Just get rid of them all. Okay, when you're trading, you don't care about anything. You don't care about how you feel, nothing. All you care about is my plan being presented on the screen, yes or no? If it is, enter the trade. If it's not, I'm staying out of the market, and that's it. Okay, that's all you need to do. So this is why we need to talk about these psychological problems, because if you don't understand them, then they may be happening to you without even realizing, and then you're just going to be trapped in a cycle of losing, and you're not going to know why, and then you're going to blame your strategy, okay? And then that gets into another big problem, which is constantly looking for a new strategy. And the strategy is not the problem. The method isn't the problem. It's you. It's your mental state. That's the problem. That's what most people's problem is. Okay, they don't work on their psychology at all. Instead, they just focus on the method, or why isn't the method working? But they don't even know what they're trading half the time. They haven't analysed what they're trading. They don't even know if they're following the plan. They don't even know if that's a winning edge or not. But they'll still blame it instead of looking at themselves and thinking, you know, was I risking correctly on that trade? Did I follow my entry criteria? Did I follow my management rules? Was I disciplined? Was I patient? They don't ask these questions. And these are the questions that you need to be asking yourself if you're going to be a profitable trader. So now that we have a better understanding of both FOMO and the fear of losing, another big problem, okay, is the opposite of not entering the market, and it's over trading. So either chasing your tail or revenge trading, okay, is a clear issue that we need to address. Now, over trading, it tends to come from a natural losing streak, okay, and then you begin to tilt and you get very, very angry that you're losing, okay? You start to get maybe scared that your account's going down. You don't understand what's going wrong. You think it's your method. You get frustrated, okay? And it leads to this horrible cycle of revenge trading. So again, let's have a little look at the diagram and each of the stages. So here you can see a losing streak turns to angrily deviating from your plan, which will then lead to revenge trading, which will then lead to a blown account, okay? So first of all, why does the losing streak happen? Well, the losing streak, okay, will happen for a number of reasons. Either it's just a natural losing streak, which means you followed your plan perfectly. This is just part of the process. This is the probabilities playing out, okay? Over 100 trades, I know that I'm going to be profitable, but right now I'm just taking some losses. That is what we would call, okay, a natural losing streak. Now, of course, you could be in a losing streak because you haven't been following your plan. And by not following your plan, you're going to be getting even more angry at yourself, okay, which is going to lead to even more revenge trading. So it's a very, very slippery slope. So let's just say, for example, we have a natural losing streak, okay, but that trader still doesn't understand that he needs to wait for his probabilities to play out, and instead he gets very, very angry at the situation. So him having a losing streak, okay, will lead to him angrily deviating from his plan. Then they are no longer following their rules, and then anything could happen, okay? And this is where the revenge trading starts. So now they're deviating from their plan because they're in a rush to get their money back. They're not happy at the fact that they had a losing streak, and now what they want to do is they're going to constantly trade, and they're going to try and get their losses back either in that same day, in that same trading period, okay? And they're not going to stop until they try and get their profits back, okay? They're going to deviate away from their plan. They're going to buy and sell everything because suddenly everything's gone out the window. They don't care. All they care about is, I need to make this money back. And that is the worst possible thing you can do, because then you become unstructured, okay? You go away from your method, you move away from your edge. And again, if you move away from your winning edge, what are you doing? You could be doing anything, okay? You're highly likely to lose. You're exposing yourself to a very, very dangerous market, okay, when you don't know what you're doing. So then you start revenge trading, you buy and sell everything, your stop losses are all over the place, you take more losses and more losses. And now you feel even worse. You're getting angrier and angrier, okay? And people just keep going. They will just keep revenge trading until they can't handle it anymore, until the pain gets so bad that they have to stop. Either they have to stop or their whole account blows up, okay? And that's where this diagram ends, with the blown account. Because for these people, they will just keep trading. They will just buy and sell. They'll keep taking losses. They may even add to their losers. They might even end up risking way more than they needed to. And they're going to keep trading, okay, until they physically can't handle it anymore. And at that point, okay, they either give it in, they get a blown account, okay, or they just quit trading. They give up. There's a clear stat, and it says that 90% of traders will lose 90% of their capital in the first 90 days. And there's a reason for this. Most people aren't designed to trade. Humans aren't designed to trade. Okay? Computers are designed to trade. We're not designed as humans to trade. So the only way you're going to be able to successfully trade is if you don't act human. And when I say don't act human, I mean don't act emotional. Because a computer isn't emotional. A computer is working solely off of logic. The computer understands that it needs to either do this or do that, okay? It's yes or no. If this happens, then this or this, okay? Not, oh, I'm not feeling very good today, so I'm not going to enter this trade, or I haven't had a very good morning, so I'm going to try and feel better by risking more on my account and having a really good positive day. There's so many different ways and things you could say, okay, and do. And it's all really, really bad, and it's going to cause you to not be profitable over a long period of time. Because at the end of the day, we want to make consistently profitable traders. And the only way we can achieve this is if you're really thinking from that psychological based mindset, okay, and that logical thinking. That's all we need. We need to be patient, okay? We can't rush into positions. We can't worry about losing streaks. We can't worry about entering the market in completely. Okay, we can't worry if we get the fear of missing out, okay, and a trade goes without us. It happens plenty of times. But again, it's just part of it. Imagine your trading is on a bell curve, okay, and you've got two extremes and then the average in the middle. This is like your trading and your trade plan. Sometimes you're going to hit one of the extremes where you have, say, you know, a great trading day or a great trading period, and then you're going to have the other extreme where you have your worst trading period ever. And then everything else is going to balance up in the middle somewhere, okay? And that is your whole trading experience. Because, you know, when we talk about equity curves and how many wins and how many losses you're supposed to have, you know, your chart isn't necessarily supposed to go up in a straight line. It's supposed to go up a bit, it's supposed to pull back, it's supposed to go up a bit. Funnily enough, just like trading and the markets, okay? It's supposed to be made up of impulses and corrections and impulses. That's your equity curve. So that's what you should be aiming for, okay? To see a nice sloping move to the upside, okay? Made up of pushes higher and pullbacks, pushes higher and pullbacks. And the whole time not being emotional whatsoever. And this now relates perfectly, okay, into how we need to use psychology within our actual trade plan, okay? Now, of course, when we trade, ideally we want to have, like we said, some kind of trade idea for a continuation and some kind of trade idea for a reversal. Now, why do we actually do this? And it's because we don't truly know whether the market is going to be moving down or whether the market is going to be moving up. We don't know. All we're doing is saying that we have an edge over time that will play out and it will make us profitable. So this is why you need to really focus on the fact of the probable versus the possible, because you need to make sure that you don't develop a mindset where you're obsessing over a potential directional move. Okay? All the time, your language needs to be very unbiased, okay? And you can't put too much weight on a particular trade idea, because the probable versus the possible. So let's say, for example, we think the market is probably going to move up. Okay, we're seeing all the signs that the market is going to be moving to the upside. We're seeing nice descending price action. We're seeing price break underneath a low. We're seeing reversal candlestick structures. Okay, we're seeing all sorts of things, okay, that are telling us that price is highly likely to move to the upside, okay? This would be seen as the probable, because it's the probable scenario of what's going to happen. Now, I'm not saying that we're going to put all of our eggs in one basket and solely focus on this move to the upside, because we have to look at the other side of the equation, okay? Because it's the probable versus the possible. So what's the possible? What could possibly happen? And of course, possibly the market could continue to move lower and maybe we aren't in the right area to call that reversal, okay? So that's why you have to remain unbiased and you have to be balanced in your analysis. You always need to think to yourself, well, what's the most probable situation that's going to happen here? But what else could possibly happen as well? So it's always thinking of both sides of that coin, okay? Because we don't know whether it's going up or going down. And if we start putting too much of a bias on a direction, it will just cause us to end up missing positions, okay? You'll be so busy trying to buy it that you miss a really clean sell setup, okay? And then market goes without you, you miss your win, it throws your probabilities out the window, and everything goes wrong, okay? So this is why we always have to be focused on both the probable and the possible, and always drawing up trade ideas for both of these situations, okay? And this will give you the best chance in the markets, okay? If you base everything, like I said, in psychology, and of course this concept of the probable versus the possible and being unbiased in the market. So now I think, okay, we've spoken about some key topics when relating to psychology, okay? We've spoken all about FOMO, we spoke about the fear of losing, we spoke about revenge trading, and now, okay, we've just spoke about how to remain unbiased in the markets, okay, and making sure you are always aware of what the market could do in either direction, okay? Because we don't want to be too laser focused, okay, and too zoomed in looking at one thing and then forget everything else that could also be happening, okay? We need to be logical traders, consistent traders, patient traders, okay? We want to be disciplined, accurate, okay? All these different things we need to have, okay? And it's just about working on it. If you feel like you're not at that point yet, then that's absolutely fine, okay? All of these psychological skills are developed over time. You just have to work on them and be aware, okay? It's fine if any of these problems get to you. It's absolutely fine, because all you're going to do is then just realize that and then, you know, make note of it and then you can fix it. And this is why I say it's really important, okay, when you look at your trade plans and when you're journaling your positions, to, of course, journal your psychology, because you need to be aware of what you're doing, okay? You may be having FOMO without even realizing it. And how are you going to fix it if you don't write it down? So you need to be aware, okay, of how you're feeling every time you take a position. Was it based on logic and probabilities, or was it based on emotion? That is the key point, because a lot of the time people will be losing positions, okay, and you won't be profitable, and it's solely a psychological problem that can be fixed. And once you know how to fix it and how to maintain it, then of course you're going to start seeing more profitability, because you're going to start becoming that logical professional trader, okay, and you're going to stay away from those emotions, okay, and those human traits which make trading very, very difficult. So I hope that you guys took something away from this. Make sure you go back through this video, re-listen to these points, okay, and make notes. I would make a lot of notes surrounding these kind of psychological topics, because you need to start monitoring yourself if you're going to be trading live, because you need to make sure that you aren't falling to the emotional traps of the market. So I hope you guys all enjoyed this video. I will see you in the next one where we're going to be going into the buy and sell indicator, okay? So it's going to be lots of fun and you're not going to want to miss that episode. So I will see you all there.
Be a dork.